I'm Charlotte McLeod with investingnews.com, and here today with me is David Nicholas, CEO of X Funds. Thank you so much for being here. Great to have you.
Absolutely excited to be here. Thanks for having me on.
Yes, excited to have you here as well. I think it's going to be a fun conversation today. I was thinking, just because it's our first time talking, if you wouldn't mind starting with a brief introduction to yourself and your work, that would be great.
Yeah. So David Nicholas, CEO of X Funds. I'm also president of a wealth management firm, Nicholas Wealth Management, as an RIA that we, for individual corporation investors as well. Really excited. We have now, the number is up to 8 publicly traded ETFs, with which a few more on the way. So really excited. We've been really unique in that we brought a lot of unique funds that aren't in the marketplace. So we always try to find something that is maybe different that can really drive some value for investors. So been at this now for 21 years. We've seen a lot of ups and downs for markets, but it's great that we have tools and products that can really help investors get hopefully an edge up in their investing world.
Yes, definitely some interesting ETFs that you have on offer, and we're going to get into a number of them today. I wanted to begin on the precious metals side. That's where we're going to focus the conversation today. Beginning with gold, this is a question I like to ask people when I first talk to them. When you're looking at gold, where do you see it in the cycle overall right now?
Yeah, so it's interesting. So gold is obviously, we've seen an incredible run for gold in the last year. I do think, I think investors also have a good entry spot, right? We've seen gold pull back from its highs. We've seen silver pull back from its highs. But I think precious metals, and you could add silver to that as well, are still kind of being driven by the same big forces, right? You got rates that are obviously an issue. You got the dollar, inflation expectations. You got geopolitics. You got fiscal stress just here as a nation as debt, when it comes to debt. So all of those forces have been driving the price of gold. But I usually, when we think about gold, is gold really a hedge against inflation, or is it a hedge against the dollar? And it's interesting because we've seen inflation come down pretty dramatically since it hit 9%, in the 2022 era. And so we've seen inflation come down, but gold actually doing really well. So I do think gold is trading mainly on two things. I think it's trading on the dollar. So whenever we saw just here recently, when the expectations for Fed rate cuts shifted to where the probability for rate hikes actually started to gain momentum, we saw gold sell off pretty dramatically. So to me, I think gold is really driving on a debasement dollar trade, but it's also trading as a safe haven, store of value in geopolitical events, worries about debt and deficits. But you also have central banks around the world now own more gold than they do treasury. So there's just been a big demand for gold. We've actually seen Bitcoin, though, outperform gold during the Iran conflict. But I ultimately think it's the dollar and it's central bank buying that are really driving the price of gold right now.
There's so many underlying factors when it comes to gold. So we'll dig into some of the ones that you mentioned. I want to bring up the Iran war, because I think the question that I'm seeing most from our audience, and also just in general online right now, people are looking at gold. They know that it's a safe haven, and they're wondering, all right, people are supposed to flock to gold in times of crisis, which certainly I think arguably we're in right now. So why right now are we seeing gold go down when this war is breaking out? And you mentioned, we have other factors at play, but what's your take on that question?
Yeah, so it is interesting, right? You would think that if gold was the safe haven asset, which it's acted like throughout history, we have many cases of that. War is normally bullish for gold, which is why it is unique. But this time it looks like the oil shock that we've seen, right, with oil just jumped the way it is really complicating that trade. So I think, obviously gold benefits. It's the fear trade. But I also think that the conflict is also driving this inflation narrative, right? And so when you see the price of energy do what it's doing, when oil spikes, inflation expectations rise, rate cuts diminish, the probability of rate cuts diminish. So I think this is why you can't talk about gold declining without really looking at oil. And I really think this is an inflation trade. But if we're not going to cut rates, that means stronger dollar. And so I think you get weakness in gold. And so I think if you get oil to come back down in price, I think you'll see gold, and rate cut expectations are back on the table. You should see gold do really well.
Yeah, we're in a time right now where it's hard to say anything for certain. What is your take on what's coming for oil prices? Obviously, we're in this uncertain time. But I am starting to see headlines about people saying, well, even if this resolves, maybe we can expect higher oil prices for longer. So what are you thinking on that note?
Yeah, so it's interesting, right? The U.S. obviously is now as a net exporter of oil. If you just look at West with WTI relative to oil prices, we see a discount for West Texas Intermediary compared to what we play in overseas crude. So the market's already telling us that the U.S. has less of a dependence on foreign oil prices. But the challenge, though, ultimately is that, right, if the price of oil is going up, it's going to impact us. When you look at the futures curve, I mean, the market's telling us that we should expect oil for longer, right? You see trading around $100 a barrel. It's an issue, right? And so I think this is where structurally, I've mentioned inflation now multiple times, but structurally it's an input cost for goods, manufacturing, travel. It's a big input cost. And so I think the markets will have an issue with it. Obviously it does matter towards inflation. I do believe though, if we get a resolution here, we've seen some record-breaking moves in the price of oil, but if we get a resolution here sooner than later, which I just saw a report about, maybe there's some U.S. airborne troops that are going to be positioned on the ground. That doesn't help that case. But if we get a quick resolution, I think oil price comes back down into the 70s. If this drags on 6, 7, 8 months, I think you stay sticky between 90 to $110 a barrel.
Maybe you can also help me unpack the Fed's path forward in 2026. And again, this is very tricky. We have Jerome Powell ending his term as chair. We have a new Fed chair coming in who I know people were thinking, well, he's going to be more in line with Trump, who wants lower interest rates. But now we have this inflation factor coming in. So anything you can say at this point about what we might see from the Fed moving forward in 2026?
Yeah, I'll tell you, like all eyes are on the Fed, but the Fed is in a very tough spot. I would say that, prior to the Iran conflict, there was a lot of momentum towards probably more rate cuts than even the market had priced in. But again, it's the classic stagflation risk where you got higher oil prices, which I already discussed. Also, you have growth that's somewhat slowing in the U.S. It's certainly not a recession, but we see slowing growth. Business activity slipped to 11th month low in March. Obviously, Iran war lifted energy prices. So I think the Fed's core message right now, and we saw this with Jerome Powell, is really just patience, flexibility. If you saw Fed President Daly just say that there's really no single most likely path to where rate cuts end up. So I actually think the Feds are taking I know it sounds cliche, but really a wait and see. Really, I think they're going to watch what oil prices do. I think they're going to continue to watch what the labor market is doing. I was looking for cues. Are they focused more on the labor market? Are they focused more on inflation? So I think those are two question marks right now, but I think one preludes the other, whereas if the war and inflation continue, I think it puts pressure on labor markets. But I have a feeling right now the Fed is going to stay put. And it seems like if you just look at the interest rates in the futures market, we're going to get less cuts or no cuts this year if everything stays status quo where it is right now.
Well, and you mentioned stagflation, and that's a word that I've seen popping up more and more in headlines lately. So for you, is that a realistic scenario or concern that you're looking at in 2026?
If it wasn't for the strength of corporate earnings, I would say yes. So while the U.S. economy is slowing, we actually aren't seeing a real deterioration in earnings. And I think that's one silver lining out of all of this is if we're going to go through conflict, whether geopolitically, can U.S. companies, manage price disruptions, manage supply disruptions, manage high energy prices? And it seems like, based on current earnings reports, earnings are coming in, I think, generally across the board better than expected. We're still seeing reasonable earnings growth forecast. So I think if we don't want conflict, but if there was ever a time where we were going to have an outside factor influencing the economy, I think the markets are at a place of strength currently. And so my base case is not stagflation, just given that I still think we're going to see real growth. And also companies are becoming more efficient. They're doing more with less. They're figuring out how to increase bottom line. So while maybe revenue isn't as robust as it used to be, I think bottom line earnings, we still see some pretty nice growth.
And that leads into another topic I wanted to cover. Many of the people who I speak with have concerns about a stock market correction or something even bigger than a correction. And especially now, there is so much volatility due to the war, but it sounds like you're seeing more of a calm scenario ahead for the stock market as well. Is that true?
Well, I would say there's different paths this market can take. If the war in Iran is something that we have to look at, if it gets to a point where we actually have boots on the ground and this is a prolonged issue, I think the market ultimately recovers fine. You're going to see a lot more short-term selling pressure, in my opinion. But again, we also have midterms this year, and again, the party in power does not want to go into a midterm in a position of weakness. So I think generally, when you look at history, the way markets move in midterm years, the expression sell in May and go away is never more true than an election year. So I would actually expect the period between May and coming back in August to be one of the worst probably performance sell in May and go away that we've seen in a while, just given the geopolitical conflict, given that it's an election year. We usually see a second sell-off between August and October, but then we generally see markets perform very well from that November to March period, 6 months after elections. So I would say I'm keeping my expectations low given geopolitical risk and also a midterm year. But as outside of our outright recession, which I don't see, I actually think this market will do very well. Divided government's not a bad thing. So I think that will push us forward on the back half of the year.
Great points on midterm elections as well. I know it's a little, people are always watching when it's an election year, and maybe you lose track when it's midterms, but definitely points to keep an eye on there. Going back to inflation, I want to take a look at the gold mining companies as well, because I know you have an ETF that includes exposure to the gold miners. And one thing I'm also hearing right now is if inflation is going up, what does that mean for the gold miners' bottom line? So any thoughts that you have on that note?
Yeah, so we really like the miners, obviously inside of our gold fund with the tickers GLDN. Just to list some of the names, I mean, we've got, Agnico, AEM, Newmont Mining, Anglo, Royal, Barrick Gold, Orla, Harmony, Equinox. So, I mean, about 50% of our gold fund is gold miners. Here's, obviously costs are a factor, but I will say when you look at these gold miners, a lot of them are not spending on CapEx. So where their break even is for many of these miners, and especially some of the top miners that we hold in our fund, like Anglo and KGC and Newmont, their break even cost for gold is somewhere in the $2,500 to $3,000 an ounce price. So where's gold trading today? It's well above that, right? Around $5,000 an ounce, give or take. So while that doesn't necessarily mean that if gold drops $1,000 bucks that they're going to be the most profitable they've ever been, but it just means that they have a pretty decent cushion to where even if it's really that price of gold, if it stays between 4,500 and 5,500, these gold miners are going to do very well, and they will continue to produce profits that are well above their 10 to 15 year averages. So inflation matters, but it's really that price of gold. So now again, inflation does impact the Fed and the dollar. But as long as we don't see major rate hikes this year, I think gold miners continue to do really well.
Yeah. It all becomes interconnected there. And speaking about the gold price, what is your expectation as we're going into the year? How do you see it going moving forward? I know we're in a tricky time right now, but any thoughts? Yeah.
So again, it has the base case narrative for gold change, and where I started was no, it doesn't, right? I mean, it's, we're still living in a world of deficits. So it's not just the US, it's sovereign nations around the world. You have increased deficit spending, you have increased debt. You've got, central banks continuing to buy gold. So I think the reasons why we were buying gold a year ago have not changed. The only thing that I think would derail the path for gold is, again, going back to the Fed if we decide to raise interest rates. But outside of that, even if we cut less, I think gold really does perform well. So I don't really see gold dropping below the $4,500 an ounce and staying there anytime soon. If anything, as long as central bank buying continues, I think you see gold 40 to 50% highs, increases for gold over the next 3 to 5 years. So there's still really good upside potential in gold, and also silver as a industrial, but also as a base metal as well.
I did want to bring up silver as well. We can't forget silver. So, of course, it's got its precious side where it follows gold, but it's got the whole industrial side as well. So, do you see a similar outlook for silver in that it could be going higher and right now is looking like a nice buying opportunity?
Yeah, so obviously silver's a little unique in that it does behave like a precious metal, just like gold, but it also behaves like an industrial metal or an industrial input. So economic growth does impact, or the state of the economy does impact silver more than it does gold. But I also think that it can benefit from just the hard asset demand. So if you believe in the like a cyclical upside for the economy still, so if we are not in a recession, if public markets are not slowing or equities are not slowing to the degree that would cause a recession, then we still think silver miners would do well. But it's also just the demand, obviously with AI, with solar, with energy, the industrial demand for silver is not going away. Silver is volatile. It can be easily manipulated with reserve requirements. So again, we think it does make sense to own the miners who have real revenues, real profits that we can put a multiple on. And so that's why we still have 40 to 50% of our fund, SLVX, in silver miners, because it's a lot easier for us as managers to really put a price on a silver miner, whereas the price of silver obviously is going to be whatever people want to pay for it, or gold as well. But at silver levels the way they are, similar to gold miners, there's not a lot of capex. These silver miners are very profitable, but we do want stable pricing. Unfortunately, I think we're going to still see some volatility in the price of silver as well.
Yeah, hopefully everybody who follows silver knows that the volatility is kind of inherent to the market. So we've got gold and silver as places that people can go right now. Maybe we're in a spot where it's a good time to buy. What else? I think people are really wondering when they look at their portfolios right now, where else can they find protection? What else should they do at this time when it's a lot of uncertainty? So anything you would say on that note, other directions that people might want to consider right now?
Yeah, I mean, again, it depends on your age, your goals, where you're at in your investing cycle. So the whole goal of investing is you want to preserve capital and you want to make a good return. And so when you look at, there's so many different areas that we can invest in right now. We've talked about gold, we've talked about metals. Obviously, treasuries is like your safest bet. We do like short-term treasuries, 2 years or less generally. Now, depending on what rates are going to happen, we would extend that out. But also, I think you have to look at some of the themes that are happening. So if you look at both nuclear and defense, we think that this is a great time for investors to actually broaden out. So when you think about getting outside of the Max 7, S&P 500, or NASDAQ, what are some of these areas of the market that have had periods where they've done well, but they haven't had prolonged bull markets? We look at defense and we look at nuclear as well. So I think those are two areas that maybe they've done very well in the last year, but there's still sectors that are, I would say, overlooked by a lot of investors. We do get some defense companies that are included into the S&P 500, but a lot of the energy and nuclear names are names that many people may not be familiar with, or they may only think of their boring utility companies that have been around forever that are slow moving and not very profitable. But we actually think energies, utilities, nuclear, and defense and rare earths are things that you should have a piece in your portfolio for to give you some additional exposure outside of large cap tech.
I think both of those types of themes make total sense right now. And I wonder if you can break down, I find this ETF really interesting, the one that is defense and rare earths. Can you break down some of the components there? Because I think one of the reasons that people aren't in this sector is maybe because they don't know how to approach it and what's contained there.
Yeah, and so we actually, when we created Weapon, which is our ticker WPN, which is hopefully easy for your viewers to remember. So Weapon really is unique in that you can't really talk about defense without talking about rare earths as well. So we say Weapon really brings together two parts of that same story, where you get the defense companies that build modern national security defense machinery, but it's also the critical minerals that are needed to really power that industry. And so we really think of them both as hand in hand. And so what our fund does is it owns the traditional defense makers, like, I'm pulling up some of our holdings here. We've got the traditional names like General Dynamics, Northrop Grumman, Lockheed Martin, but we also pair that with some of the newer, I would say, defense contractors that are involved in drone technology, like ONDS, AeroVironment, AVAV, but also some of the names like that we all know, right? Palantir, right? I think the world is quickly figuring out why Palantir trades at 100 times forward for moments like these, right? When you see in the Middle East where we're using data, information, cybersecurity, Palo Alto, PANW. So we really look CrowdStrike, CRWEs in the portfolio. So we almost think marrying traditional defense contractors like Lockheed Martin, Northrop Grumman, with drone names that are at the forefront of the conflict right now in the Middle East, AVAV, Ondas, and then really looking at some of your cybersecurity names as well. That for us is great defense exposure. And then we add our metals, our commodity sleeve, which is we have aluminum in there, we have copper, we have uranium, we have lithium and battery tech, we have steel, and we have platinum. So those are all the inputs into defense. And we actually think, again, some of these names can be volatile, but we really think critical minerals is really now a national security issue. And we think there's going to be a lot of resources poured into finding critical minerals and rare earths. So as investors, we would like to be invested alongside that. So why our fund marries the two. And then we have an options overlay to generate income as well. So really unique. It's the first of its kind. So we're really excited about it.
I think the pairing definitely makes sense with defense and critical minerals. They are so intertwined right now. This has been really educational. I won't keep you too much longer, but before I let you go, are there any final thoughts that you would leave investors with? It's definitely an interesting time to be in the markets right now.
Yeah, it really is. And I would say if you look at a chart of the market over the last 20 years, and I could probably point to you 2 or 3 times throughout the year where it would give us reasons to sell or give us reasons to be very concerned and worried about. And I'll tell you, it's every single one of those reasons, a year later, the markets are generally trading higher. And so I would just say, like, in the middle of these volatile moments or uncertainty, if you remain prudent and stay diversified, I would encourage our listeners, though, just because if every part of your portfolio is going up at the same time, you're probably not diversified enough. So it's okay to have some sectors that underperform to really act as hedges or defensive positions. And I think gold, silver, defense, and nuclear are great areas. It may not outperform in the next month or 2 months, but they're great to really provide you broad diversification. So I'd say stay diversified, but don't fight the urge to get out of the market.
Perfect words to end on. Thank you so much for coming on today to talk about gold and silver and much more. This was great.
Absolutely. So great. Thank you for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is David Nicholas with X Funds.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.